Mike Wilson of Morgan Stanley writing, if there is a stable resolution in the Middle East, the bond market might walk back the Fed hike it's currently pricing in. Our conviction in the current bull market is intact. Mike joins us now for more. Mike, always great to see you. Thanks for being here. Let's start there. This idea of what a bull market means. Does it mean stocks just go up and to the right, or does this mean that there is some sort of cyclical undercurrent that shows an economy that truly is strengthening?
Well, let's go back to why we're in a bull market. It's all about the recovery from the rolling recession from a year ago, this operating leverage story. It's an earnings-driven bull market, right? So last year we got the multiple expansion in advance of, predicting that was going to happen. And as you recall, going into this year, there were a lot of kind of boo birds on the economy. People were very nervous about earnings. And we took the opposite view. I mean, nominal GDP is booming. It's 7 to 8%, and that's in place. So what's going on now is the multiples coming down, over the last 6 months, but the earnings have been so good that the market can still go up. So the next phase of the bull market at this stage typically is multiples are flat to down. Earnings come through as expected, but that can drive the stock market higher. And you get rotations to the areas where that earnings growth is underappreciated. And we think that yesterday's action is some evidence that maybe we're going to have that next rotation. We've already had several rotations this year, and we think that next rotation is in some of the areas you mentioned, like regional banks or consumer goods, which are asymmetrically, positively, inspired by oil prices coming down.
This has been the argument, that the rally in the equity market is entirely driven by fundamentals. And then SpaceX happened. How much does that kind of torpedo some of this thesis?
Well, look, I mean, markets are driven by fundamentals and animal spirits at the same time. I mean, you can't separate the two. They work in harmony. And so, yeah, I mean, is it a little frothy right now in certain areas? I mean, not necessarily. In areas, there's a lot of leverage in the system in semiconductors, as an example. And that's coming out now a little bit. That's something we wrote about 2 weeks ago. To me, that's a healthy development as long as there's some place to go to, right? And so if there's no place to go to, then you can have much more serious downturn that can turn into something that's more severe. We don't think that's happening. We think this is a normal transition. I want to go back once again to the beginning of the year when people were really, kind of pessimistic about growth. All we've seen this year is one rotation to the next from commodities. What happened this year? The Fed started printing money again, right? They did the RMP. That went into gold and silver stocks. Then it went into metals and rare earths. Then it went into energy stocks. Ended up in semiconductors. What do all those have in common? They're all commodities. So we've had a commodity rally basically bouncing around. And we think now we're going to get that broadening out story that was kind of going in January and February. Then it was halted by the war in Iran and the oil price spike and the repricing of the Fed. That now is subsiding. And so we can rotate back to some of these areas, pro-cyclical areas where the earnings are quite good, but they're underappreciated by the market.
What if we get a hawkish Kevin Warsh? Could that hurt the rotation?
Well, define hawkish Kevin Warsh. I mean, there's a couple ways to think about that. I think one is on the rate side, which I think is unlikely. The other's on the balance sheet. And we don't really know yet how he's going to want to position that. What I would say, and we wrote about this past week, is we already know what's happening, which is that, Jay Powell left him a nice little package, which is that we're basically already seeing a deceleration in the RMP. So this is I've spent the last 2 years painstakingly trying to follow liquidity because that has been the main driver of kind of the animal spirits. And it was very positive at the beginning of the year when they restarted the RMP or asset purchases, and you had Treasury buybacks as well, and the SLR, increased some capital from the banks. That now is decelerating, right? You've gone from $40 billion a month in RMP to $10 billion a month. So that's a deceleration that's already in place. He's inheriting that. Is he going to come out and say, hey, we're going to increase that? Probably not. Is he going to say we're going to kill it? Probably not. But that deceleration is still in place. So I think we already know the answer to the test, We're having a deceleration in liquidity in the moment, and that, to me, as we've been talking about, is sort of that's where you can have this sort of summer chop and summer correction. Like in this rotation yesterday, you said it already, we're getting a rotation in a down tape. That's what I expect. We're going to get a down tape, but we're going to get a rotation, and that's a signal that we're seeing a leadership change.
What's the next risk on the horizon? The market was able to get through tariffs. Obviously, they're looking beyond now the conflict in Iran. For the rest of the year, is it just that potentially, I mean, the president says if he doesn't like what he sees in Iran, he'll start strikes again. Is that what potentially could be disruptive?
Well, I mean, your viewers probably won't like me saying this, but the markets moved past the war. They moved past tariffs a year ago. I remember in this time last year, June of 2025, everybody was still harping around tariffs, and we had said a month before, like, we've moved past tariffs. And so I feel it's the same thing. The other thing we learned in this war, which is amazing, okay, and I didn't expect this, is we just learned how much supply is out there, okay? I mean, like if you had the situation, this is a perfect storm. If you were an energy bull at the beginning of the year, by the way, energy stocks did incredibly well, and then they peaked literally the day of the attacks. So if you think about this event, you can only get to $125 in oil. And if you inflation adjust that, that's so far below where we were in the Russia-Ukraine war that began, 5 years ago. So that, to me, is just a really strong signal that the world is very resilient in terms of finding energy supply. China's a big part of that because of all the storage. But to me, it's a very bearish view for oil going forward.
You're pointing to something that's fascinating. Do you think that the trade in terms of bullish on commodities is ending? The idea that that is going to be the outperforming sector in the rally, which has worked at least year to date?
Well, no. I think what I'm saying is that there are multiple types of commodities. And the reason why commodities have done so well this year at different times is because of the liquidity picture, which was so robust. We've written a lot about this the last 2 weeks, which is we think that between the Fed, the Treasury, and then the deregulation, they've added over $500 billion of liquidity to the system. So the whole rates argument is a sideshow to me. It's just a sideshow. I mean, it's been neutral. Yes, has the Fed been less dovish than expected at the beginning of the year, including me? Yes. Have they been way more dovish on balance sheet? Absolutely. And that has trumped, the negativity. Now, having said all that, multiples have come down this year. Okay, so multiples have come down because we're later in the earnings cycle. We're going to get a peak rate of change in earnings revisions too. So the combination of peak rate of change on earnings revisions, peak rate of change on liquidity tells me that we're in a corrective mode right now.
Well, I guess another way to ask this is, do you expect that Fed Chair Kevin Warsh to pull back some of this liquidity in the face of these pockets of froth, as you called them?
It's already happening. It's already happened. In other words, the path has already been set. We're having a deceleration, okay, or a deceleration on the rate of change of liquidity being provided to the market. That's what the market's picking up on now. The question, which you may or may not answer today, is what are you going to do going forward? Are you going to be active using the balance sheet in helping funding markets stabilize, which is what the last Fed chair did, Jay Powell, which is still there, by the way, so they're probably having a conversation about this. So, I think they will ultimately. Like, in other words, I think the Fed and Treasury will provide more liquidity if they need to. But right now they don't need to because bond volatility is totally under control. Funding markets are totally good. We're seeing issuance of equities and credit being absorbed. So they don't need to do anything right now. Why spend your bullets? And so there's a lesson in that. We kind of need the markets to pressure them to provide more liquidity. And the reason why we need more liquidity is because the economy is booming, okay? I mean, we're growing 7 to 8% nominally. That absorbs a lot of capital. Money supply is only growing 6. So that money's got to come from somewhere.
Do you think that the market could still hit your 8,000 target for the S&P by the year end if you do see a rotation away from some of the hyperscalers, away from some of the semiconductors, given how much they've rallied, given the proportion of them into the entire rally, and given how small the relative economy has gotten in response?
Yes, because I don't expect these stocks to correct more than whatever 5–10%. I mean, they're going to correct and then they're going to come back. Like, I don't anticipate that this is the end of the AI CapEx cycle or the end of these stocks working. I'm just saying the relative outperformance doesn't make sense to me given the relative earnings revisions in these other areas. And by the way, just a reminder, that happened at the beginning of the year. At the beginning of the year, these stocks were all underperforming. So, it's just the hot dot becomes all, the attention of the market goes right there. And I like to try and think 6 months in the future. Like I try, my job is to tell you what's going to happen, not what is happening. Okay, that's harder. And so people don't like to do that, but I try to do that. And I'm telling you that I think we're going to get a rotation, but it doesn't kill the bull market.